Yeah, and again, we really try to strike the right balance. Our salaries are going up by percentages are higher than that. Energy cost has been up higher than that. So we really try to find a balance between making sure that partly we pass on some of the inflation that we're seeing on our own input costs, but at the same time keeping it moderate. As you were saying, we have been investing hundreds of millions of pounds in our pub estate. We operate ourselves over 2,500 pubs in the UK. And actually, we are outperforming the category. We're very pleased with our results in the UK, as I said earlier. It is also not just the investments in the pub. We also believe it's the power of the portfolio, with Moretti now the largest lager brand in the on-trade, Beavertown being the largest craft brand in the country. We see a lot of growth in premium cider like Inches and Old Mout. So quite pleased in general, I would say, with the performance in the UK.
Yeah, and I guess you'd never have that problem that some people would have of running out of 0-0 just before Christmas. But we won't name any rivals on that one. In terms of the buyback, yeah, I bet you love that. I bet you... Actually, do you know, did you like that story? Let me, before I ask you a sensible story. Did you like that one, or was it just marketing?
Look, we have a lot of respect for the brand that you're referencing. But again, we're super proud of our portfolio. And as our share and top-line performance shows in the UK, we're quite pleased.
Yeah, fair enough. That's as much as I'm going to get out of you on camera about that. So what about the buyback as well? As much as these are a good set of numbers as well, the shares have been underwhelming. You know that as well. Is the buyback just a little bit of a boost for those shares at this point that the investors are asking for?
No, we have a very clear hierarchy of our capital allocation principles. It starts by investing in the organic growth of the company. As I was mentioning, the investments we're making in marketing and selling. We're building right now 3 greenfield breweries, new breweries in fast growth markets like Mexico, Brazil and Dubai. So that's always our first priority. It's really about the optimal capital structure. So we really need to be and want to be below 2.5 times EBITDA. We always will look at good inorganic opportunities like what we did in India and South Africa recently. But then if we have surplus cash, we do want to make sure that we return them to capitals. We're very happy with the step up in our dividend, up 7.5%, more now than €1 billion, as well as indeed the share buyback, 1.5 billion over a 2-year period. But it's really a clear and consistent hierarchy of capital allocation. We had very strong cash flow generation last year, up significantly, passing the €3 billion mark, which allowed also our leverage to drop to only 2.2 times EBITDA, which really maneuvered us in the position to consider and decide on the share buyback.
Dolf, let me come back in on tariffs, because you've shrugged off the impact of those aluminium tariffs, the 25% that we're talking about from Trump. If there are no carve-outs here, how does it not have an impact on pricing in the industry? And how do you think we could see some of the manoeuvring from other major players in getting around any increase?
Yeah, so one thing that is good to know about the beer industry, and in particular for Heineken, that the beer industry is capital intensive and is very local. So in over 70 countries, we have local breweries with 80-90% local sourcing, operated by local people, selling to local consumers. So as such, it's an industry that's a bit less susceptible to disruption in international trade flows. On the tariffs, yeah, we like to joke internally, we have green bottles, we don't have crystal bottles. You know, we don't know more than you do. We keep following things attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there. But again, we keep following it. But given our footprint and our local-for-local structure, for us, the impact is at this moment assessed to be relatively manageable.